Alright mate, picture this, you're sitting in a mortgage broker's office in Sydney, laptop open, and there's a listing on screen for a pretty ordinary 3-bedroom house that just sold for exactly $1 million. And the broker turns the screen around and shows you the number you'd actually need to earn just to be considered, and honestly it's nowhere near what you expected. That's the exact moment I want to walk you through today, because most people genuinely don't understand how this number gets worked out until they're sitting in that chair themselves. And by the end of this you'll know exactly what the bank is really testing, what pushes that number up or down, and why there's no single magic income figure that works for every Aussie. Here's the bit almost nobody gets right, and it's basically why this whole question is so much trickier than people think. Banks in Australia don't just look at what you earn and what the house costs, they run something called a serviceability buffer, which basically means they don't test you against today's interest rate. They test you against a rate that's at least 3 percentage points higher than whatever you'd actually be paying. This comes straight from APRA, the regulator that oversees our banks. And as of their May 2026 update, that 3 percentage point buffer is still very much in place. So say you're borrowing at around 6.5%, the bank's actually stress testing you as if you're paying closer to 9.5%, even before any of the lender's other assumptions come into play, just to make sure you wouldn't be in trouble if rates went up. But here's the thing, it's not identical everywhere. Every bank runs its own servicing method on top of that buffer, which is exactly why two people earning the same income can walk into two different banks and get two completely different answers. Now let's get into the number everyone actually wants. And I'll be straight with you, there's no single figure that guarantees you $1 million house in Australia. If you're going in with the standard 20% deposit, that's $200,000 up front, leaving you with an $800,000 loan. Run that through current rates with the buffer applied. And for a single applicant with no dependents, no debts, minimal expenses, you're often looking at something in the mid-100,000s as a rough example, sometimes closer to 155 to 165 depending on which lender you go with. But that's an illustration, not a rule, mate. Your real number depends on your income, your tax situation, your actual living costs, dependents, any existing debts, and that specific lender's own policy all tested together. Not some simple 30% of income formula like a lot of people assume. Here's where it gets interesting though, because that starting figure moves depending on stuff most first home buyers never even think to check. Take a credit card sitting in your wallet with a $10,000 limit. Even if you pay it off in full every single month and it sits at zero, lenders generally assess you against the limit, not your actual balance, because they need to know what you could draw on, not just what you currently owe. That alone can meaningfully knock down your borrowing power. Same deal with the HECS or help debt, though I want to be precise here, the impact isn't some fixed dollar amount. Help repayments scale with your income. So a $40,000 help debt hits someone earning $80,000 very differently to someone earning $150,000. Direction's the same, it reduces your servicing capacity, but how much really depends on your specific numbers. Here's something that gets misunderstood constantly and it's worth clearing up properly. Lenders use something called the Household Expenditure Measure, or HEM, as a benchmark for living costs. But it's not quite the blunt tool people think it is. APRA's guidance says lenders should generally use whichever is higher, your declared expenses or an appropriately scaled HEM figure. So if your actual spending is unusually low, the bank's not ignoring you, it's just applying a floor, because it needs some baseline assurance you can actually live on what's left after the mortgage. That's genuinely different from the bank just overriding your real life with some random government number. Now the part that gets misunderstood the most, and it's worth getting right. You've probably heard banks won't lend more than 6 times your income. That's not quite how it works. APRA's actual rule brought in this year limits how much of a bank's total new lending can sit at a debt-to-income ratio of 6 or higher, capped at 20% of new loans. That's a restriction on the bank's overall lending book, not a hard ceiling on what you personally can borrow. Plenty of approved loans sit above 6 times income, it just means fewer of them can, across the whole bank. So if someone tells you 800,000 divided by 6 means you need exactly 133 to qualify, that's just not how the rule actually works. The other lever worth knowing about is who's on the application. As just one example, some lenders might assess a single applicant on 150 as able to borrow somewhere around 800 to 900 grand, though again, that shifts a lot based on expenses, debts, and the lender, so treat it as a scenario, not a guarantee. Bringing a partner onto the application usually boosts your borrowing power, but it's not a simple addition, their income comes with their own expenses too, and any dependents get factored in, so the improvement's real but not always as big as people expect. Let's talk deposits for a sec, because this is where first home buyers actually have some genuine flexibility. The federal government's first home guarantee lets eligible buyers get in with as little as a 5% deposit, no lender's mortgage insurance. That's a real solid scheme, but don't assume every $1 million property automatically qualifies, Eligibility and price caps depend on your location and the current program settings, so definitely worth checking against your specific suburb before you bank on it. What stays consistent though is the basic mechanic. Smaller deposit means bigger loan means higher repayments, which pushes up the income the bank needs to see from you, even before LMI comes into it if you're outside that guarantee scheme. And here's the bit that trips a lot of people up when they're picturing $1 million place, where that house actually changes the whole upfront cost picture. Stamp duty concessions for first home buyers exist in most states, but the thresholds and exemptions vary and change over time. So rather than throw you a number that might be outdated by the time you're watching this, honestly, go check your specific state revenue office for the current rules before you budget around it. Because assuming a concession that doesn't apply to your price point or postcode is one of the more expensive mistakes people make. So let's bring it all together, mate. For an $800,000 loan on a $1 million property, an income somewhere in the mid-100,000s can work as a useful starting illustration for a single buyer with minimal debt. But there's no single figure that applies to every Australian. Your lender's going to look at your income, your tax position, your actual living expenses, existing debts, dependents, and how your specific repayments hold up under the stress test, and that combination genuinely varies from person to person and bank to bank. So the real first step isn't chasing one exact number, it's getting your existing debts sorted, understanding your real expenses, and getting a proper assessment from a broker or lender who can run your actual numbers. That's what actually tells you where you stand. If this cleared things up for you, do me a favor and smash that like button. It genuinely helps more Aussies find this. If you're not subscribed yet, now's the time, and turn on notifications so you don't miss the next one. Catch you in the next video.